On Saturday, some surprising and unexpected news came out of Europe related to the bailout negotiations with Cyprus. In this video, we will cover what happened, how the markets may react, and ways to monitor the severity of the reaction in terms of managing risk and reward. In addition to kicking off with Cyprus, we'll review CCM models, what they tell us relative to normal corrections, and then we'll look at 3 ways to monitor the reaction to Cyprus, the most important being the VIX. We'll also look at the aggregate bond market in terms of what was it telling us on Friday and what may it signal next week. We'll do the same thing with the emerging markets ETF EEM. During all the chess moves, money printing, loans, haircuts, and bailouts in Europe over the past 5 years, bank deposits have always been kept safe. That's no longer the case. As part of a new bailout deal for Cyprus, the government will basically be confiscating a portion of all bank deposits. Some legislative hurdles still need to be crossed. A vote will most likely take place on Sunday or Monday. A fair question may be, why does all this matter? The biggest concern for the financial markets is one of precedent. As we mentioned earlier, bank deposits so far have been off limits. Depositors have been kept whole, they've been kept safe. Now we have a new precedent where confiscation of property is no longer off limits. The most concerning thing, if Cyprus did this on their own, probably not a big deal, probably barely makes a ripple in the markets. But the bigger issue is this idea and concept is being backed by the European Union and the IMF and being supported and pushed by them as terms of the bailout. Another concern would be, although there's not many creditors left, it was the depositors that took the haircut here and not bondholders. There's a question of fairness that comes into play and social unrest and those things. And from a precedent perspective, especially since it's backed by the European Union and the IMF, the fair question becomes, if they think it's okay to do it in Cyprus, what says that the EU and IMF eventually won't back confiscating deposits in Spain, Italy? And ultimately, that could spook the markets. The markets are well aware that Spanish banks are still sitting on large and unrealized losses, and you can connect the dots and say, if they did it here, they could do it here. In terms of a possible market reaction, news events are never as important as the market's reaction to them. So we'll just have to see how the market reacts. We'll look at a bullish reaction and a bearish reaction here. There's a possibility that the response will be somewhat muted. The market will look at it as a unique circumstance. Cyprus is different. They won't do this in Spain. They won't do this in Italy. And there is some basis for that argument. If you look at banking liabilities in Cyprus relative to the size of their economy, those liabilities are 8 times as large as their annual economic output, which is a massive problem. It is different from the Eurozone as a whole, which is less than half of that. So the unique argument does hold some water, and the market could look at it that way. Another bullish note is we've had political unrest in Italy in the past few weeks, and the markets have digested that extraordinarily well. So while you would think on the surface that this would be bearish, and we think it will be, you just have to see how the market reacts. The most likely reaction is a bearish reaction, and it revolves around the concerning precedent that we discussed on the last slide. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. With the Cyprus news coming out on Saturday, it's a good time to revisit this table. We've talked about this in past videos. It's we don't need to spend a lot of time on it. These are the three major CCM market risk models. This is the composite. This tells you is the median stock market top for a correction occurs for this index at 70. We've recently been as high, and when I say recently, past 2 or 3 weeks, these are the readings. We've been as high as 74, which is above that. The risk model's been at 98, well above the median peak prior to a correction. The BMSI, as we noted on Twitter last week, did hit the very rare 100 number, which shows a very, very strong trend, which says it's possible that this market will react better than we think to Cyprus. We don't need to know in advance how the market will react. We just need to pay attention. The reaction is more important than the news event itself. BMSI hit 100, very rare, tends to be bullish longer term, but overbought short term. Average peak or median peak occurs at 89, and the composite recently has been as high as 89. A typical peak, the median at 83. The average peak occurs at 84, and if I average these two numbers, it comes out to be about 83 and a half. Moral of the story, wouldn't be surprising if Cyprus is the news that set off a correction. The market's definitely reached a point where typically it has already corrected. Typically a market has already pulled back. We're past that point now. We'll enter Monday with an open mind and see what happens. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a weekly chart of the VIX, or the volatility index. It looks very busy and complex. The concepts are very easy to understand. We put this chart together before we knew about Cyprus, and now it will be even more useful now that we have a negative news event. This is the VIX here. This is the S&P 500 here. Concepts, again, are very easy. We're going to be looking at simple support and resistance, spikes in the VIX, and trends. Point of the exercise. During the last few years, dating all the way back to 2010, the VIX tended to find support in all of these areas here, and those areas are denoted or highlighted via these dotted horizontal lines, and these are the levels. So what once was support may now act as resistance. So if we have a spike in fear, one of the ways that we can gauge that is to see where the VIX goes relative to these lines. If the VIX spikes up and recaptures all of these areas and spikes right through these potential resistance levels, that's bearish for the stock market. You can see with the VIX here, this is a clear downtrend. When we get the spike in fear and we break the downward sloping pink trend line, the S&P 500 corrected. Downward sloping pink trend line in the VIX, a big spike in fear, the S&P 500 corrected. Downward sloping trend line, spike in fear, S&P 500 corrects. Downward sloping trend line broken right here, close to a correction. You'll notice the VIX spikes above this somewhat bull-bear demarcation line right here, also foreshadowing this rollover. So in terms of managing how the market reacts to Cyprus, if the VIX moves up into this area, not that big a deal. If it clears this downward sloping trend line, we become more concerned. If it moves into this area, especially on a weekly close, we would become even more concerned. So this is somewhat of a way to monitor how seriously the market is taking the situation in Cyprus. We just covered the VIX. I want to expand a little bit on something we tweeted on March 14th. So the big picture of the S&P 500 looks good, but concerned short term with some stock versus bond charts and charts related to the VIX. The concerns with the stock versus bond charts can be illustrated just looking at the chart of AGG, which we'll do next. Setting the stage here, we're looking at the AGG ETF, which is basically looking at the aggregate or total diversified bond market. Point of the exercise is to use AGG as a proxy for risk off. Here we just have the S&P 500 daily in black as a point of reference. Here's the emerging markets in terms of managing risk, and here's the emerging markets EEM relative to the S&P 500 down here at the bottom. Here you have an uptrend in risk off, clearly defined uptrend. Stock market drops when bonds are in favor. Here we have a short-term downtrend in AGG. We'll look at potential trend changes in AGG and how that impacts the stock market. Three things have to happen for a basic trend change. We've got a downward sloping blue trend line here. Step one, you break the trend line. Step two, you have to make a higher low. This low here is higher relative to this low. And step three for a trend change is to make a higher high. This high here is greater than this high here. This completes step three for a trend change. Let's see how the S&P 500 acted during the three steps. Step one, AGG breaks a downward sloping trend line. Here, as it turns out, this is the beginning stages of a consolidation process in the S&P 500. Step two is where the orange line is. This is the higher low relative to this low. And as it turns out, that was the peak for the S&P 500. Step three, when bonds begin a new short-term uptrend, occurs here. This high here is higher than this high here. That's an important higher high. And as it turns out, this new uptrend in risk off, or AGG, signaled a rollover in the S&P 500 short term. This is your correction from the September peak to the November low of 2012. During that period, when the stock market was consolidating and rolling over, EEM basically went sideways, pulled down, and went up. EEM also, on a relative basis during all this, held up fairly well. So next week, if the S&P 500 does roll over and EEM's relative strength continues to be weak, I think that's a red flag. If EEM and some commodity-related investments can't catch a relative bid relative to the S&P 500 in the next few weeks, that would be a bad sign. Let's look at where the market is as of Friday's close. This is a chart that we identified during the week last week, and we marked this chart up on Friday after the close prior to knowing anything about Cyprus. We have a downtrend here in AGG. Looks similar to this short-term downtrend. Step one of the trend change, breaking the downward sloping trend line. Step two is here. This low here is higher than this low here. Step three would be to exceed this high here, which for AGG on a closing basis was $110.66. So where we are now is we're basically in this area here where we haven't made the higher high yet. But you can see that became an issue in terms of the stock market rolling over. Point of the exercise, if AGG is weak and bounces down in this direction, that's bullish for stocks, especially if it can break this trend line here as well. More likely what will happen with the Cyprus information is AGG will take out this resistance here. What once was support now may act as resistance. What once was support here, here, and here may now act as resistance. So from a prudency standpoint, being patient with our longs on Friday seemed to make sense. You had bonds here rallying, but coming up against two forms of resistance right here. If AGG breaks above this resistance, that would lean bearish for stocks. And more importantly, if AGG can close above $110.66, that would increase our concerns next week. As we saw in the last chart, AGG closed Friday underneath two forms of potential resistance, and EEM, or the emerging markets, also closed above support. So there's no question on Friday that the markets were pushing envelopes. This is pushing a bearish envelope in this direction, and AGG was pushing a bullish envelope for bonds, which obviously would agree with this bearish envelope for stocks. As of the close on Friday, it was obviously prudent to wait to see what happened. Bonds had not broken out, and EEM remains above these trend lines here. This is downward sloping trend line. Even if you think that EEM is in a downtrend, this is the parallel trend line here. We closed above it on Friday. EEM in the past has held here, 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 and here, and in the general area here. If you were patient here, it bounced. If you were patient here, it bounced. Patient, moved higher. Patient, moved higher. It's possible this time patience will not be rewarded as it was in these historical cases. However, it was prudent to try to be patient on Friday based upon what we see here. If we come down in this direction on Monday, which we may or may not, very difficult to determine how the markets will react to Cyprus. The guess is that it will be negative. If that's the case, we would be cutting our position, if not eliminating it, in this area here. We'll go into next week with an open mind and see what happens. One quick point on this risk-on, risk-off chart that we use in the Shivako Capital Management Market Risk Model. This is the S&P 500 stocks relative to IEF or bonds. As you know from watching our videos, when the ratio is rising, that's what risk-on looks like. This is the S&P 500. When it's falling, S&P 500 looks like risk-off typically. Point of showing this. Here, we're in a situation where resistance came into play and the ratio reversed. You'll notice here the S&P 500 corrected. If I move down on this line here, this also acted as resistance for the ratio. If I move up, the S&P 500 corrected. So the only point here is this is resistance, stocks corrected. This is resistance, stocks corrected. If I follow this line up, are we at a logical point where stocks may pull back? Sure we are. Have to see what happens here, but if we moved in this direction, it would be similar to this point here and this point here where weakness followed. You can also make the argument that this is a bullish breakout here. It was retested here, and as this chart sits as of Friday's close, on Friday, March 15th, there's no question this chart leans bullish. The only concern would be is we're near resistance. We'll close with this chart with the same basic concept. This again is SPY divided by IEF. You can see here this general area acted as resistance. If I come down, this general resistance area also coincides with a consolidation and weakness in the stock market. If we move up here, we're in the exact same area now. So if this chart and this ratio moves in this direction, that's bullish for the stock market. If it reverses and comes back this way, that's bearish for the stock market, as it did here previously during this consolidation and correction. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.